Welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, talking a little bit today about a thought experiment about the markets using long-term analysis. This past weekend's newsletter, I discussed the idea that maybe March was just a decline and not a bear market. And if that is the case, what does that mean longer term when we're looking at monthly trends and monthly analysis? Now, this is very long-term in nature. So if you're a short-term trader, this is not really going to apply much to you. But if you're a longer-term investor like we are, looking for long-term returns, long-term benefits to our customers and clients, this is a little bit of an important analysis to mentally think through in terms of determining what future outcomes may be. Looking at the long-term psychological cycles of markets, investors tend to go through the same repeatable pattern of behavioral tendencies over time. Currently, we may be back into that return to normal phase at this point after this recent correction, hoping that the world is going to return back to where it was very quickly without really understanding what the longer-term dynamics and timeframes have looked like. If we go back through history, the one thing that drives markets over time is fundamentals and valuations. Yes, I know sometimes valuations don't seem to matter, but ultimately long-term they do. In fact, at every point in history where valuations have been as elevated as they are today, markets have struggled to make returns over the next decade or so as those valuations are ultimately reverted. The one thing we haven't done since really 1980 is revert valuations back to a level that have normally consisted of the beginnings of true long-term high return bull markets. And we haven't had that opportunity. But if we think about this type of dynamic and break markets down into full market cycles rather than bull markets and bear markets, think about them all as in one cycle, what we find is there's really only been 3 full cycles of the markets, really going back to 1871. The first cycle was through the Depression, second cycle through the 50s, 60s, 70s, and of course this last cycle started in 1980 where we are today. The one thing we haven't done yet, as noted, is that we haven't reverted valuations back to very low levels below the long-term trend of valuation cycles over time. Now, if we apply the psychological cycle to the valuation cycle, we start to see a very interesting pattern emerge. The first cycle was 63 years in duration and pretty much followed exactly the psychological pattern over time until we actually reverted the excesses through the Great Depression. Second cycle lasted 45 years, going into the 50s, 60s, and 70s. Again, saw the same type of activity until valuations were ultimately reverted in the late 70s and early 80s. If we take a look at this same idea, overlaying the psychological cycle with the market currently, from 1980, we see the same pattern developing. And again, we're seeing this market rally here currently on the short term of this return to hope nature of the psychological cycle, which suggests that there's potentially the risk of a mean valuation reversion beginning at some point in the near future. Going back to our analysis that we did in our recent newsletter, we see some of the same similarities, right? We've had this very long bull trending market. The correction that happened in March kept us within that bull market cycle, but has started the process potentially started a process of a topping cycle here, but forming the left shoulder and the head of a topping pattern known as a head and shoulders pattern. Now, Jim Colquitt of Armor Index actually emailed me over the weekend talking about this very same pattern and laying out the dynamics of what might actually occur if we complete this topping process. A test of the neckline would lead either to a rally back to 4,100 on the S&P 500 or a break below the neckline would lead to a decline to about 2,000 on the index in the short term. Long-term dynamics show, though, however, the retest could be as low as the bottom of the markets in 2000 and in 2008. But these are just long-term dynamics of markets and talking about the resetting of valuations over time, particularly when looking at the idea of investing long-term. Again, valuations may not seem to matter today, but valuations always matter over the long term. As Warren Buffett once said, price is what you pay, value is what you get. That's 3 Minutes on Markets and Money. I'm your host, Lance Roberts, realinvestmentadvice.com.